It's the economy, stupid. That's what we're told every day. Yet it's up one day, down the next. Jerome Powell is too slow. Others say that he got it just right. Here to help us sort it out is my new friend, Dick Eide. He spent 34 years on Wall Street working for JP Morgan, and he was head of the bond department. And he also wrote a newsletter that talked about the economy and, in particular, the Federal Reserve. Dick, welcome to The Truth.
Happy to be here. Good to see you, John.
Thank you for joining us. So, which is it? How do you grade the Fed? I actually have tried to be a defender of Jerome Powell, but I also lost faith last fall when he lowered interest rates unexpectedly a half a point just before the November elections. I felt like many that was pure smacked of pure politics. And then he waited so long to give us any interest rate relief. So how do you assess the Fed's performance today?
Yeah, well, you asked me this question off air, and I told you, and I will always tell you, that monetary policy, I think, is the hardest thing to grade the Fed on. The Fed does a number of jobs for this country, and monetary policy is by far the hardest and most subjective of them. So any Fed, whether it's run by Alan Greenspan or Paul Volcker or G. William Miller, Mariner Eccles, for God's sake, you can go back to the 30s. At best, our monetary policy tools are blunt, not terribly effective. They're usually late, meaning reactive rather than prospective. And Powell fits right in. He's blundered in policy pretty much the whole time he's been in the job. But I don't grade Jay Powell on that, even though I do grade him quite low. It isn't because of monetary policy. It's because of the other things the Fed does that he did so poorly at. Number one is communication. Communication is the most important single thing they do. They have an effect on their policies that have nowhere near the effect on markets and on people's attitude towards the economy anywhere near as much as what they say. And he has just been so backwards in his communications that I can't give him any credit because I don't think he's been honest, and I think he has been sometimes worse than that, actually misleading. So that's why I give him low marks.
Well, we know that the notion of cycles is not just a dreamed up thought. They are real. Since the 20s, we have seen economic cycles. Where do you put the United States and really the world today? We don't live on an island any longer. Where do you put us in terms of an economic cycle?
Yeah, and I would make a distinction between the growth cycle, meaning what's going on in the real economy, and the credit cycle. I mean, in the credit cycle, we've been so expansionary for so long that we have to be somewhere near the end of an expansionary credit policy. It really started with the mortgage crisis, where we intentionally went off the rails to try and solve a short-term problem. Short-term problem meaning that my bank and several others were technically bankrupt. So they had to solve that problem to get us out of that mess. And they flooded the zone with liquidity and capital. They forced a lot of mergers. And ever since then, it's been one form or another of credit joyride. Credit spreads are very narrow. Yields are far lower than the historical average relative to inflation and relative to growth. They still are, even after all these years and after a certain amount of tightening for a bad bout of inflation. So that cycle, I think, is very far along, and that we will go into a period at some point where credit distinctions are made, bankruptcies are allowed to happen, failures occur, and you'll get a sorting out in the credit markets again, where strong credits borrow at favorable terms and weak credits borrow, if they can get in at all, they borrow expensively. The economic cycle itself I think is a lot faster than the credit cycle. because it doesn't rely at all on previous experience. The reason the credit cycle takes so long to play out is that if the Fed comes to your rescue every single time when you run into a bunch of bad loans, that bankers are never going to stop making bad loans. That's what we do as bankers. We make loans, and if we get away with making lousy ones with good spreads in them, we'll do that. So that isn't going to stop. Whereas the economic cycle has got so many more factors in it, right? I mean, we talk about it every day: trade, tariffs. Trump's trying to get us back to where we have a much better balance between our ability to export and our ability to import, right? So that becomes a huge factor. Labor market conditions. Um, I don't know. I could argue that in the grand cycle, we're at a very exciting stage in the U.S. economy. We have reasonably full employment. We have a labor force that is not going on strike every other day, which is a terrific thing. We have access to resources better than ever now that Trump's back in. With drill baby drill and all that. And of course, the big kahuna is AI, right? So I would say that we are in the midst of in terms of the big cycle in economics, we're in the midst of a massive expansion.
Well, that would seem like an optimistic outlook to me, which I share, by the way. But then you listen to these people that I really like and respect, like Robert Kiyosaki, who wrote Rich Dad Poor Dad, and Ray Dalio, who is has one of the biggest hedge funds in on Wall
And
Street,
a great trader, by the way, a great trader.
and Jeremy Grantham, who is a billionaire several times over, Michael Burry, who was the
Big Short.
inspiration for The Big Short,
Mhm.
the movie and bestseller. They're all predicting doom and gloom. They say that we are on the verge of a bubble and that the whole thing is going to go crash and burning any second now. Now, the only problem with that is they've been saying it for 5 years.
Mm-hmm.
And when Biden became president, and I listened to these guys tout their doom and gloom, I actually chose to go into the equity market and sell some of my positions because I felt like I was too far out on the risk curve and was leveraged. Now I regret that I did that because I left a lot of gains on the table. So the question is, are these guys right? Are they onto something, or are they going to be like the proverbial broken clock, and they'll be right twice a day in the big scheme of things as relates to the economy?
Yeah, great question. And of course, that's one the Fed has to look at all the time. Is when people are talking doom and gloom, are they talking asset prices or are they talking about the real economy? That list that you just read off are some of the great asset price geniuses of our generation, John. And what I have found in a long career of working with those guys, trading with them, having to listen to them, they regrettably had to listen to me. That a lot of times those two issues are conflated, and what they probably mean when they give that doom and gloom thing is they're referring to asset prices. The real economy is subject to one of the greatest reversion to mean trades of all time. Basically, we're alive, we're healthier than we've ever been. Most of us go to work. The kids mostly go to school. At the margin, there's problems with all these things, but the economy has a momentum of its own. If you look at the 1930s, which was, doom and gloom in spades, it was very high unemployment rate, but most people were working and going to school and going and seeing the doctor and doing what we all do every day.
So you talk about asset class. Aren't a lot of those assets propped up by debt? And I mean, we were seeing unprecedented debt all across the globe. Nations are borrowing like they've never borrowed before, like drunken sailors. Consumers are borrowing. Institutions are borrowing. It seems to me that the real threat is the amount of over leverage that people have taken on.
Well, we're living proof. The U.S. and this Federal Reserve are living proof that that's not a problem at all. Because when you have too much debt, you simply reflate and debauch the currency, which is what we've done. So anybody who's issued debt that's payable in a fiat currency, as long as they have the government at their backs, has no problem whatsoever.
Well, Jerome Powell did say that he was going to stop buying bonds.
Well, it'll be
That's a
interesting.
way of propping up the economy, is it not?
Yeah, no, it's there was no excuse for QE when they did it, and there's still over 6 trillion of it on the books, and there's still no excuse for it. Look, all they did when they did that was carve out at its peak $10 trillion that the U.S. government never had to borrow. Instead of going into the market and borrowing it like most people have to do, they just put it on account over at the Federal Reserve. The Reserve printed the money to pay for it and said, "Oh, it's now an asset on our balance sheet." So it's the classic debtor's trick of turning a liability, a debt, into an asset. We just changed it. We changed the name and put it on the books of an instrumentality of the government rather than the Treasury.
Well, and it gave us 9% inflation in the process,
It
right?
sure did. Well, I mean, among other things, but yes.
Well, I've got the impression I'm optimistic, as I think you made the case for.
Mhm.
AI obviously is a big stimulus. Some people say that we're approaching a bubble. I don't believe that. I think we're approaching the point where we're actually going to start to see a return on the investment in AI, particularly in the realm of robotics. I want one. I can tell you, I'm going to get me a little pet robot as soon as they're commercially available at a price I'm willing to pay. But and at the same time, it seems to me that President Trump is literally remaking the U.S. economy. He has imposed tariffs like we've not seen in decades, resulting in a projected $650 billion of newfound revenue. The big beautiful bill gave tax breaks, codified the 17 Trump tax breaks. We've got energy costs that are coming down rapidly, coupled with a $15 trillion that has been pledged in new investment in the United States as we remake our manufacturing sector. Finally, Jerome Powell gave us some interest rate relief, which was the last brick in the mosaic, I feel like. Doesn't that all spell the entrance of a golden age?
Yeah, no, that's a good rundown on the positives. And as long as you don't get a rekindling of inflation while these wonders to perform are all occurring, then you're fine. You're out of the woods. The fact that the Fed has not hit its own imposed target of an upper band of 2% on inflation, the fact that they haven't hit it in 2 years, some people, Ray Dalio would be a good example, don't think that's really a great track record to start easing money and expanding again on. It's like, whoa, Nelly, let's at least show that we mean when Powell says almost every time he speaks, we are committed to full employment and stable prices. Well, we already know the stable price thing is BS because stable prices is no price changes. The Fed officially adopted 2% because they didn't like managing to stable prices. It was too much risk of deflation, which they see as a real problem. So they changed it to 2%. But they haven't hit that target in 5 years either. So what Powell should be saying every time he opens his mouth is we're committed to reasonably full employment and unstable prices that inflate at the rate of 2% a year. And that's because it isn't a two-direction thing. It's only up.
But there is a little problem in all of that, isn't there? And that would be unemployment. I heard you say earlier that you thought we were approaching full employment, but it ticked up to 4.3% in the last numbers that we were given. And that's a long ways from the 3.3% unemployment that we enjoyed under Trump 1.0.
Yeah.
So don't we have another 33% of jobs that could be filled if that analysis is correct? And it's just 1%, but it sure feels like a lot if you're among the 1%.
Well, with no disrespect to people who are unemployed, In macroeconomics, you would tend to look at the aggregate numbers. 4.3 I'm showing my age here. I think of bad unemployment as 7%. Pretty bad is north of 5. Amazing is 3, and 4 is as good a target as any. There's a lot of literature on this, John. What is full employment in the U.S.?
And how many people actually are unemployed who are looking for a job?
And exactly, discouraged workers are probably quite low, actually.
Hmm.
Again, that's the conundrum that Powell, because of prior bad acts, finds himself in. He's basically having to ease into a failed price target. He hasn't hit his price target in 5 years. He's been the Fed chairman that entire time, right? And he's never hit it. And yet, like a wind up doll, every time he gets up, he goes, and we're steadfast in our commitment to stable prices. Which I mean, I don't even know what that's supposed to mean. It's a regurgitation of the dual mandate, full employment and stable prices, but there's nothing in his track record to suggest that he's ever really paid the slightest attention to that.
So the one thing in President Trump's formulation that I'm disappointed in is that he has not offered anything really in a meaningful way in terms of budget discipline. And I thought with Bessent and the Secretary of Commerce both talking about working towards a balanced budget, maybe there was some glimmer of hope. But I don't see anything, I haven't read or gotten any indications that they're even really making a step in that direction. I was hopeful that the tariff, 650 billion, combined with Doge, 250 billion. Now we're talking about a trillion. Now we're start talking about some real money that could afford meaningful budget discipline and debt relief. But I don't see any indication that they're even thinking about it. It
They're not.
seems to me that Trump is planning, or his strategy is to outrun it, that he's trying to raise the size of the ocean so that all the ships will benefit.
Yeah, and he said that many times, including when he was running. The only solution here is to grow your way out of it. And I think Bessent would say the same thing, not in a speech, but if he were talking with you just as I am right now. No, the debt bomb is real. The thing that list you read off earlier, the thing they're talking about is a real problem, but it's not that there's no solution to it. You simply have to show that you can grow faster than you're accumulating debt. You start to pay down debt. We did it in the 90s a little bit, and people will feel a lot better about the sustainable debt load.
Well, I would feel a lot better about it because we got 37 trillion
Right.
in debt, and interest all of a sudden is the single largest line item in the federal budget.
Yeah, bigger than defense. Yeah.
Now, Rand Paul and Ron Johnson think that we are at a tipping point and that it's all going to collapse and come crashing down if we don't get serious about trying to curtail spending.
Well, and I think they're serious when it comes to cutting fat. See, the way I would view Trump is as he's a builder, he's an expander. That's his history. We're both New Yorkers. I had an opportunity to bank him once, didn't. The the way he looks at the world is that it's there to be built upon and grown. So to expect him to be careful about debt and expansion, I don't think that's not the Donald Trump that I know. I would expect him to act as he is acting, which is let's get involved in AI, let's control that, let's put a big footprint on the world defense wise, let's make sure we're not having to fight any back actions, because what we're really trying to do is get all this fresh investment here in the U.S., get our industries built back up, finally achieve some fair trade, where we have at least a chance to export something or build for export. Before it's all been rigged, right? I mean, he's absolutely correct. That was his best issue when he ran the first time, and it was best issue when he ran the second time. The American working man has been screwed by the people who own the businesses, right? And um, obviously, as a banker in New York, we were a lot closer to the people who owned the businesses, and we tended to support that kind of thing, even though we knew it was very bad for jobs and even worse for wages. Because when you start importing cheap labor from abroad, the first, the not the secondary effect or the tertiary effect, the first effect is that means American workers can demand less. Now they're competing against, the guy over in Vietnam or down in Haiti.
Well, it has never worked for our country. I
Yeah.
mean, going back to the 1800s when we brought slaves to America, we're still paying for that decision. And it has cost us in so many ways, both real and uh, intangibly.
Yep.
Then we've done the same thing really by bringing Hispanics into the United States. I am in favor of allowing Hispanics in to fill jobs that no one else will step up to, principally in agriculture, harvesting crops, in construction, in hotels and hospitality and restaurants. I mean, every business that you go walk by has got a help wanted sign in front of it. And so depriving those business owners of an adequate labor force is not helping anybody. And if we can give a helping hand up to people in less advantaged countries and allow them to work here legally, I think it's a good policy. That's just the world according to John.
Yeah.
But there is another potential boon and problem looming that we talked about briefly, and that is AI. I mean, Musk says that his robot is going to do meaning trivial, uh, monotonous, repetitive, dangerous task. Well, I'm thinking that you could replace.
Sounds like trading bonds.
Sounds like some war wounds exposed there. But really, you can think about roofing, you can think about welding, you can think about the things that are patently dangerous, um, that would be replaced by a robot. And I'm thinking that you could eliminate or you could fill all the unfilled jobs in the country if you can get a legitimately trained robotic force that could go out and do those jobs. But that then begs the question of what about the people that you then displace from those jobs?
Hmm.
So it does feel like a real conundrum to me.
Well, again, in aggregate terms, I wouldn't start worrying about that until I saw a big spike in unemployment that was directly attributable to AI. I think it's always possible to see the boogeyman, like, oh, it can do everything. It's wonderful. People are endlessly resourceful on how to use their time and something. I mean, would you have ever, John? This is a good one. You're a little younger than me, but we're kind of from that same generation. Would you have ever thought there was such a job as a TikTok influencer?
No,
No, me neither.
no, it actually it looks like incredibly easy money to me, and I'm trying to figure out an angle because I'd love to be a star on TikTok. I just don't think our age group really appeals to the audience. That's
No,
the problem in that.
I did. All I mean is, here's kids that could otherwise have gone to work for J.P. Morgan and learned how to do one of the things they do there, and they're going, heck no, I can do this right from home. I get a following. I get people sending me cash, Venmoing me cash, for one thing or another, and all of a sudden I'm supporting myself as a TikTok influencer. So this is where um, I think there's some alternative theses about what AI actually does. I think it changes the labor force, but whether it really diminishes it or not, or narrows it, I doubt. I think actually what we're going to find out is that you and I sitting here on this call, we can't come up with what the labor force is going to look like in 25 years from now.
Totally.
We'll just be wrong.
And to argue against the point that I was making, and I wasn't really advocating that position, I'm just asking the question. One answer to that is that there's been a lot of talk about a guaranteed minimum income for all Americans, and I think that is could become a real potential if the hypothesis that I posed should prove to be true. But Jensen, the CEO of NVIDIA, said, "Don't worry about it." But in his company, they've got 40,000 programmers, and each one of them has an AI assistant. And so it's really like an executive assistant or an apprentice that actually helps them do their job. What is the result of that? Phenomenal increases in productivity.
Yeah, exactly. And that, which is, remember, that's what the internet did too. We got those big jumps in the 90s. You know, you look at non-farm productivity in the 90s, it's the best spike in the whole graph. I'm looking at a 60-year graph on that, and it all came off every time internet speeds doubled. You got another big pop in productivity. Well, AI is just another one of those speed changes on the storing and manipulation and retrieval of data. You know, it's the biggest one we ever saw, and it is going to have that effect.
So I want to go back to one thing that we were talking about earlier. Um, the S&P 500 typically trades at about 15 times earnings. We just did a quick Google search, and it looks like the S&P. I don't believe this number. Anthony, who's a better producer than an economist, came up with 28 times earnings. Is that even remotely possible?
Yeah, it's in the 20s. I hadn't I don't, you know, I don't follow those multiples too much. I was trained by my customers not to, and they said the problem is those are always trailing earnings, and what the market is really doing is forecasting future earnings. So they never liked multiples as a measure of whether we're expensive or cheap. You know, these were hedge funds. I mean, these were serious players who just said, Dick, don't waste your time. Don't look at multiples.
Well, that's good insight that I lacked. So I thank you for
Yeah.
that. So interest rates are somewhere around 4.1%, I believe, for the Federal Reserve overnight interest rate.
Oh yeah, and the overnight. Yeah, right now the curve's very flat. Yep.
And so where we know where we are, we know where we've been. Where do you think we're going?
Steeper. I think the curve will be steeper. That's part of normalization is getting, if the person's going to take the risk to lend the money for longer term, they earn a higher rate. That's what's called a normal curve,
Sure.
right? And it's
And
the
we've had an
interval.
inverted curve for several years now, right?
Exactly. And every time you have a normal curve, that enables the risk taker, the person who's actually making the investment either in 2, 5, 10, 20, 30 years, to judge, is that enough additional reward for me to go out and incur all the uncertainty that goes with time, right? Time equals uncertainty when it comes to rates and other volatile variables like that. When you have an inverted curve, it usually means some exogenous force has forced it into that shape. In this case, the exogenous force was today's topic, the Federal Reserve. They put not just $10 trillion on the books, they bought all long paper, 30 years, mortgage backed securities, 20-year notes, and 10-year notes. And that's why I say it was an abomination when they did it. And it still is because it created a weird set of incentives to invest. They were doing that intentionally. They were so afraid of the stock market crashing in over the mortgage crisis that they put QE in. If you recall this language, Bernanke called it the portfolio balance channel. And that was one of his theories for once you went beyond the zero bound in the Fed funds rate, and we went right to zero. So we were beyond that bound. What else can you do? What other tools do they have? And he found some precedent. I can't remember, it was Finland or someplace like that, that had pulled this in that very weak period right after World War II. And they did this thing of going out and buying long Finnish debt at the time, and it worked. Now, if you go back and look at the example he was citing, the whole purchase and then subsequent runoff of those securities back into the market, the whole thing only took 18 months. Last time I looked, we're in year 16 from the mortgage crisis. So this has become a permanent fixture that, God forbid, I mean, Powell should get at least some credit for knowing that that was not a good direction for the Fed to go, and at least right now, he's not making the situation any worse so far. You watch, if there's a crisis, they'll jump again. They'll do it again.
Dick, thank you so much for a great primer on our snapshot on our economy and some real insights into the way that the institutions of our government work to keep the economy going. And if you like what you've heard from Richard Eide, you can enroll at the Florida Gulf Coast University and take his seminar on history, governance, and governance of the Fed and the Federal Open Market Committee. What a great opportunity to talk with you, Dick, and thank you so much for your generosity of time and your knowledge.
Thank you, John. Appreciate it.